From the morning reading, this is a one step forward, one step back kind of market. We basically traded sideways all year as we approach the halfway point of 2015. After a nice bounce off the 50-day moving average yesterday, the S&P 500 has pulled back below it today. Along with the S&P 500 as a whole, the consumer staples, energy, industrials, materials, and telecom sectors are now below the 50-day moving averages as well. Last week at this time, the S&P 500 and three sectors were overbought, but we've got no overbought sectors after today's decline. The current distribution count is a concern, but not yet strong enough to launch a correction. More worrisome than the count, perhaps, is the bunching. The indices have incurred either distribution or stalling, a subtle form of distribution, in 3 of the past 5 sessions. The global stock market rally is running into trouble. That can be seen more clearly in foreign markets. EFA falling below the 50-day moving average after backing off from overhead resistance formed last June. Its daily MACD lines peaked in early March and have been dropping since then. The negative divergence is a warning sign. A lot of today's foreign selling is coming from Europe. Increasing Greek tensions may be hurting the Eurozone. It's not a good sign for U.S. stocks when foreign developed stocks are dropping. Emerging markets are doing even worse. EEM is falling below the 200-day moving average to its lowest level in 2 months. It has also fallen back below its February-March peaks, which is another negative sign. The EEM rally fell short of its September peak. That's another global negative divergence. Emerging markets are being hit on 2 fronts. One is the recent surge in global market yields, which usually pulls money out of higher yielding and riskier developing markets. The other is the recent drop in commodity prices. 2 of the hardest hit EEM markets are Brazil and Russia, both of which are commodity and energy exporters. Even the Chinese market is showing some weakness. Since global markets are normally positively correlated, it's better for the U.S. when foreign stocks are rising. It's more dangerous when they're falling, as they're doing now. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:27 a.m. Central Time, and I'm recording this in preparation for the market day of June the 5th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's dive in and see just what's going on with our overnight activity. Obviously, we got a couple big reports that come out today. First of all, you had just a few moments ago, I saw the headline about OPEC keeping output unchanged. The line was OPEC delegates said the cartel would keep its output level unchanged at 30 million barrels a day. Second time in 6 months it has decided to take no action amid a global glut of crude and weak oil prices. Obviously, they've been trying to break the backs of higher cost producers such as the U.S. shale market. Along with that, you have in just a couple minutes, and it's likely to change these views on the overnight, is the monthly unemployment report. So obviously, very important report about to hit there as well. At this moment, at the time I cut this, you had the U.S. broad market indices were just a little weak, but not very much, and that frankly could totally reset here once the monthly report comes out. Crude oil before this OPEC report came out was down about 0.34%, euros down about 0.17%, bonds down about 0.5%, and then gold down just slightly. On the other side, we have China up about 1.5%, really the only bright spot in all the markets that we review each morning. Hong Kong down about 1%, Japan about scratch, Germany down big, about 1.3%, and the United Kingdom down about 0.83%. As I mentioned earlier, the big report, of course, today is the unemployment report, and that should hit here in just a moment. Also be aware that during market hours we have FOMC member Dudley speaking, so always a wild card with that. With respect to our current volatility conditions, obviously we had a tick up yesterday. Short-term VIX is now at a 15.02. You see the skew just below the 125 area, in which we would call that, something of a warning sign. IV percentiles at 28, 19, 27, 44. So obviously a little bit of an uptick, but let's keep this in perspective. There's nothing particularly fearful with those levels. We did have a standard deviation move put in 3 of the 4 markets yesterday. The S&P, Russell, and Dow all up more than 1 standard deviation. I should say down more than 1 standard deviation moves. But this is still relatively low. We've only had 3 standard deviation or greater moves in the last 2 trading weeks, so slightly below normal there. Obviously today could bring that up to normal. In terms of our regular daily report, a lot of mixed bag here. We still have this big picture, phase 3, higher highs, higher lows. Even with the recent weakness, we're just in the middle of the range. Indeed, we can take a quick look at that. You take a look at SPX, we're just literally right middle of the range. There is nothing extraordinary about this on the chart as it stands right now. Obviously, we've had weakness ever since we came back from the Memorial Day holiday, but it just put us back in the range. And Russell back in the range. NASDAQ in the range. The Dow Jones, it's probably the weakest of them, but it's still, probably bottom half of the range, but it's in the range. There's nothing yet here that takes things up a notch. Now, as this report comes out, and I'm seeing, looks like the immediate reaction is down. But big wick on it so far. Obviously, it'll take a few minutes to digest the report. One of the things that we'll have to kind of figure out is, if it's good news in the report, the market may take that as bad news because of the interest rate anticipation. So it's one of those twisted logic kind of things. The market may respond poorly if it is a good report, or it may take a good report and think that that's good. Who knows how we will respond in the next few minutes. All we do, of course, is trade by the price reaction. You see here, quick look at transportation. This has been something that's been of concern of late. Obviously, the big breakdown in the last week or so had recovered some, but then yesterday gave back everything that it had gained the prior day. So an awful lot of reasons for weakness. We talked about EEM. And the headlines, look at that. I mean, the EEM is just falling off. And then the developed markets also not doing well, though still above the cloud, just barely. So a lot of poor warning signs coming from various places that certainly are concerning. But still, when it's all put back into the big picture, phase 3, higher highs, higher lows. IBD status still confirmed uptrend. GMI index did fall a couple notches to a 4 out of 6. You have your market posture is bearish. S&P bearish, Russell bearish, Dow very bearish, NASDAQ still holding on to very bullish. So some mixed signals coming there. The most important one, of course, being the S&P. It is solidly bearish at a 59 and falling. Our overall hedge warning status, 0+, normal with cautionary aspects. We do have a number of volatility warnings, market in decline, sharp increase warning, the VIX daily squeeze. Look at the distribution day count. I mean, it didn't take very long for this to start building. S&P 4, NASDAQ 4 at 5. We call this a warning sign. And the skew was okay, but just barely below the 125 that we would call that a warning sign. Look at the New York Stock Exchange new high to new low. 379 new lows put in yesterday. So clearly a warning sign there. We've had our S&P crash warning indicator on our E-mini chart that has flashed some time ago. And finally, in the risk aversion indicators, 2 of the 5 indicators are flagging as risk off. So a lot of mixed signals here, and continues to be that theme that we've talked about of a not healthy bull market. And yet at the last 2 words, bull market, we're still bull market until proven otherwise. Now we may find out more insights with that action today. Right now, the results from the unemployment rate report, big wick down, but starting to immediately close that. And you know, so often what we seem to see is with these big reports is you get the initial reaction and then you get the backfill. It takes you right back where you started from. And then you have to wait for that next reaction. Really, it's kind of the third reaction. The initial reaction, the backfill, and then the real move to understand where the market actually is going to take and digest that news. So still too early to understand where that is. In terms of our special opinions, option income strategies, no change. VIX is inside the acceptable window, but consider increased volatility. Cover calls, still cautiously bullish. Looking for a 3-to-2 distribution between in the money and out of the money strikes. And then finally on put selling, conditions are acceptable, but consider put credit spreads with defined risk, or consider scaling into positions until the market has confirmed a breakout from the trading range. That should be enough for today. I guess we can spend just a moment here. Sector market posture. Look at this. A lot of red here on both short and intermediate. Only retail holding up as up across all 3 time frames. But you see here, when you look at percent change, it doesn't matter that your posture is up if you're negative on the day, and really negative 1 day, negative 5 day, and almost everything is also negative for the 1 month and 3 month time frames as well. Not great signs for a market that's supposed to be bullish. So that should be enough for today. As always, greatly appreciate what you do for us and liking us on YouTube and sharing with your trader community. If you've got feedback or suggestions and other things that we should be looking at, certainly support at falconglobaltraders.com is the email address, and we welcome those comments. More information about how we actually apply this information into our daily trading can be found at this website. Performance matters, we get it, and we're quite transparent with our trade journals and logs and real-time live chat. Disclaimers as always. Hit the pause button if you need more time to review this. And we'll see you back on Monday morning before the market open.